Welcome back to the channel. Today we're going to be looking at 3 very popular dividend stocks to see if they're undervalued and now is the right time to buy. If you are familiar with my channel, you know I'm a big investor in the S&P 500 index and it's hitting all-time highs once again. Simply one of the best long-term investments out there. But a lot of people want extra income on top of these gains, and this is where dividend stocks come in. So in this video, I'm going to be going through 3 dividend stocks that not only provide steady income, but also have the potential to grow over time. So let's have a look at these stocks. The first one I want to look at is ticker symbol XOM, which is Exxon Mobil Corp, currently trading at $121 a share. We are going to be looking at my automated stock valuation spreadsheet, which will give us all the latest company financials. And then we can also look at the different models, the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So put in the ticker here, XOM, and this will load all the latest company financial data, as I said. Price of $121 a share, market cap of $536 billion, a PE of 15.08, and I believe the market average is around about 30.28, so way below the market average. Earnings per share $8.03, and a beta of 0.9, meaning it is less volatile than the market. Analysts are saying it is a buy with a target price of $1.3018. Now dividend 3.33%, meaning you'll get paid $4.03 a share each year. Dividend is around about 17 billion, and in terms of free cash flow payout ratio and payout ratio from the net income, it is safe, 52 and 69%. Ex-dividend date is the 14th of November, so buy your shares before then if you want to get paid your quarterly dividend. So let's quickly jump into the revenue. 350 billion, down from its all-time highs. You can see it had a big jump up. Well, we'll go through the full story here. This is going back to 2009. It was up and then down, and then a certain thing happened in 2020 where it dropped off, and this is when I was screaming buy at this point. And then they, over 100 billion before that, at 413, and then down slightly, but it is increasing again to 350. We're not quite back in those 2019, 2014 numbers, but is trending the right way. Next is net income. What are they doing with that revenue? How much profit are they making? And they're still incredibly profitable company. 33.7 billion. You can see it got hammered in 2020 during the pandemic years and has slowly been increasing once again. Free cash flow ratio. Free cash flow ratio. This is free cash flow. 25.32 billion. Now this doesn't tell the full story. What I do like to look at is the operating cash flow versus the capex. That is free cash flow, operating cash flow minus capital expenditures. And we can see here capex is steadily increasing, which is good, but the operating cash flow is increasing as well. So you can see here, yes, it is down and down again, but you can see operating cash flow has increased from those 2 years, and capex is slightly. So yes, free cash flow is down, but capex is up, which isn't bad. Shares outstanding, what are they doing? Well, they're buying back shares. You can see here they were issuing more shares, it was increasing, but then they've restarted their buyback program, which is good. So let's have a look at the discounted free cash flow model. This is a way of valuing companies, looking at their future free cash flows and discounting them to today's value. Currently, we're going to look at some averages here, and you can see it averages out about $30 a share. So that would be not a buy, but let's take a deeper look at the numbers here. Firstly, we're going to look at revenue. We're expecting about 9% or 10%, sorry, growth each year. Let's see what Yahoo Finance has to say. So what we'll do is we'll look at the revenue numbers. They are actually, on average, you can see revenue is down 345 and 334. On the high side, it is bullish 374, sorry, and 400 billion. But also they are expecting positive growth over the next 5 years, about 3% annum. So all over the place really here. I'm going to be a bit more on the bullish case, but we're going to bring this number down a little bit. We'll go to about 5%, so that brings it to a $25 stock. Net income margins, this is too low. Let's really take an average of these last few years. And that brings us at about 11%, brings us to a $47 stock. And this one is all over the place here. Free cash flow to net income, we're going to take an average of these last 2 years. That brings us to about 87%. So there you go. Now that's a completely different story to what we were seeing here. This is why we can't just, plug things into a sheet. You do need to look at the numbers and see if they make sense. Now that puts it at $170 a share. So let's just see what we think here. Yeah, but even if we take the sort of last month here, so if it was 75, that brings it to 148. I think this is a lot more realistic number based on the discounted free cash flow rather than that $20 a share originally. Now we'll have a look at the dividend discount model quickly. We're looking at this is sort of the average growth of the dividend versus the discount rate, and it gives us currently $63 a share, which I think is a bit on the low side. If they were to grow at their most recent number of about 4.4%, this would be $100 a share. So we really want that dividend to still be growing at least 5% for this to be a buy according to the dividend discount model. But that is promising, as they have been increasing their dividend over the last few years. And in fact, if we do take an average of sort of these numbers, I wish we had well, the problem is you don't always have all the numbers here, but you can see here it is increasing, and that's what we want to see. We'll then look at the Ben Graham formula for intrinsic value, but if you are interested, check my Patreon. Links are in the description. So this is Ben Graham formula for intrinsic value, looks at earnings per share, PE of a non-growth company, times corporate bond yield, and the current AAA corporate bond yield is, I believe, still the same, 4.95%, which we have here. And I think we saw that analysts thought it was going to be growing quite not great over the next 5 years per annum. Yeah, 3.1%. So if we put 3.1, that brings us to an $84 stock. So realistically, they would have to be growing somewhere in the region of, well, 10% really for it to be a buy. But currently, yeah, not a buy according to the Ben Graham formula for intrinsic value. But finally, this is one of my favorite things, is the comparable company model. This is a way of valuing companies, looking at similar companies of industry sizes, and we can look at the revenue growth rate, EBITDA, net income, profit margins, price to sale, price to book, PEG, EV, which is Peter Lynch's price to earnings growth, EV to revenue, EV to EBITDA, PE, and forward PE. So companies that I do think we should compare to is BP, ticker symbol BP. Another one is Shell, ticker symbol Shell, funnily enough. And this is the most different one, CVX, which is Chevron Corp. So this will load all the latest company financial data for these three companies, and we can have a compare. So enterprise value, Exxon is the largest, revenue largest as well. Second highest in revenue growth rate, these are negative. Chevron actually beats it very slightly. EBITDA highest again, and net income the highest as well. Profit margin, 9.6%, beating all these again. I think compared to these companies here, I think Exxon is probably looking the best value. Obviously, we're seeing some red here, but we'll talk about that in a sec. Price to sales, the market average is currently around about 3.09. These are all below the market average, but Exxon is the highest. Price to book, I think a similar story as well. Market average is around about 5, or it's gone up again, 5.2. These are all sub 2. And price to earnings growth, this is quite interesting. So you can see Shell and Chevron are closer to 1. Basically, Peter Lynch's price to earnings growth, 1 or less is undervalued, 1 or over is overvalued. And Shell and Chevron are the closest to 1, with Exxon, being a 6. So EV to revenue, EV to EBITDA, PE, and forward PE. Forward, well, you can see here, overvalued according to that, overvalued according to that. Current PE, though, does look undervalued, $140 a share. Interesting enough, forward PE, despite having the current, second lowest forward PE, it actually does have the highest forward PE. Sorry, I'll say it again. Second lowest PE, highest forward PE. So overall, not looking to buy on these either. $106 a share based on averages. Only PE is looking undervalued. But as we said, the dividend discount model does kind of like it. And of course, the discounted free cash flow model likes it as well. And pays a very nice, as we saw, 3.33 dividend yield. So that is the first stock. The next one I want to look at is a dividend paying tech company. That's a weird way for me to say that, but ticker symbol CSCO, and that is Cisco Systems Inc. Currently trading at, well, just a cent short of $58 a share, and now it is $58 a share, going up. Wow. Okay, so now we'll go back to the sheet and we'll put in the ticker CSCO, and this will load all the information for Cisco. So $230 billion market cap, P of 22, which as said before is lower than the market average of about 30. Earnings per share, $2.54, and a beta of 0.83, less volatile than the market. Analysts saying, actually, interesting enough, it's not a buy at the minute, or it's actually about fairly valued at $57 a share. Dividend, we're talking here, 2.85%. $1.65 per share. Dividend is safe, but on the free cash flow ratio, a bit high, 82%. Net income, 64%. Pardon me. Ex-dividend date, buy your shares before 2nd of January 2023 if you want to get paid. Oh, need to take a drink. There's a lot more talking than I normally do. So we'll look at the revenues. It looks like they've released their full year revenue. So actually, before we do anything, I'm going to look at this sheet and just make sure everything's okay with this, because I have two sheets here. I have one that looks at the trailing 12 month, but if the trailing 12 month is not relevant because we've got the full year's earnings, we won't look at that here. So you can see here the trailing 12 month and the number here is the same, but current year is down actually from 2023. That was their best year ever, but still trending upwards generally. You can see they do sort of have consistently these little blips up and then drop down, but normally Cisco is trending in the right direction, which is what you want to see. Net income, different story, 10.32, sorry, did I say the number there? I should say the number, 53.86 billion. Gotta say the number. Then net income, 10.32 billion. Sort of the least it's been in quite a while, actually, basically since 2018 when they were not profitable at all. They've kind of been hovering around this 11-12 billion mark, and there was 10 there as well. So 2 years on 10, 2 years on 11, and 1 year on 12. So yeah, still very profitable, but it is decreasing, which is not what we like to see. Free cash flow is down. Let's see what the reason is for that. 8 billion. So if we look at that, operating cash flow is down. It's not like they've just spent loads on capex. You can see very gently, very slowly, sorry, the capex spending is actually decreasing, but the operating cash flow is down, which is not what we like to see. Shares outstanding, they are consistently buying back shares to reward shareholders. That is what we like to see. So let's go into the discounted free cash flow model. So $82 a share, looking like a buy immediately. So let's have a look at these numbers and see if we agree. We click on here, it'll go to the Yahoo analysts pages. In breaking news, I don't know how breaking this is. Fed, easy for me to say. Fed slashes interest rates by 25 basis points in second consecutive cuts. Well, there you go. Average estimate 56 and 58 billion, and they're also expecting about 3.7% growth. So he said 58 and 56 billion. So what we can actually do is be a bit more bullish on these numbers here. Let's put it at about 3%. So this is even going to be more a buy. $86 a share. Wow. Net income margins, I think these are a bit higher. Let's take an average of the last 2 years of around about 18%. Brings it down to $72 a share. And you know what, I'm not hating this number, but we'll just be a bit more conservative here and look at the most recent number. Need to update these actually because these numbers aren't right anymore. But $71 a share. So this is kind of on quite conservative estimates, I would say. Discounted free cash flow says it is a buy. Dividend discount model. Yeah, you can see that they sort of have, well, 2.74% growth. And that means that we'd have to bring the discount around quite a bit. Oh, sorry, I put a comma in there, my mistake. So with a discount rate of 5%, it's kind of overvalued slightly. So really we would like to see this at around about 2.74%. Oh my God, I can't type today, my mistake. Sorry, everyone. Yeah, so if the discount rate was 5%, it would be a buy at 70. If with its current value about yeah, see, it's all over the place, really. I think with a discount rate about 6%, 5% is it's fair, but they do need to consistently, increase their dividend by quite a bit. Obviously, if we had 7.5, yeah, really we need the dividend to be much more increased than what it is. Really, we need to go back to those 2020 numbers before a certain thing happened, and then they really started decreasing their dividend increases. So finally, or not finally, we'll look at the Ben Graham formula for intrinsic value. I think we saw the expected growth rate was around about 4%. Normally, Mr. Graham does not like these kind of stocks too much. Yeah, 4%. And that's been bullish as well, $29 a share. He does not like it. But that's why we look at the comparable company model. So some companies I would like to compare to. This one's a bit out there, but I think that it is. They do a lot of similar things. Obviously, the size is completely different. But Microsoft, ticker symbol MSFT. Next, we'll look at IBM and Dell. Nice ticker for a company. Oh, in fact, IBM as well. God. So, enterprise value. I'll wait for Dell to load here. We are loading quite a lot of data. There you go. So, enterprise value, Microsoft is in a world of its own there with about 3 trillion. But Cisco, IBM, very similar sizes, and Dell about half the size on them. Revenue, lowest revenue, interestingly enough, but it is the only one of the Microsoft that has positive revenue growth. So that is excellent to see. And net income, second most profitable, only behind Microsoft, and actually the highest profit margins again, only behind Microsoft. I think I'm going to be repeating this quite a lot. Price to sales, slightly lower than market average, which I believe is around about, oh no, sorry, this is price to sales, 3.1, higher than the market average. Price to book is 5%. 5.12, sorry, not percent, and that is lower than the market average. Price to earnings growth, highest, actually, no, second highest, I misread that. Second highest, 2.29, similar to Microsoft. Dell, interestingly enough, less than 1, which means Peter Lynch would say it's a buy. So let's have a look at these numbers here. We have EV to revenue, it is the second highest. EV to EBITDA, second lowest. PE, lowest PE, and second lowest forward PE. So if we take averages of these, 68, 61, 72, and 52, puts us around $67 a share. So that is good to see. So discounted free cash flow model likes the stock. Comparable company model likes the stock. Oh, actually, what I want to do, let me just put Dell there. I'll let this load again. And then I'll also put Microsoft down here, and then we can compare just Dell and IBM. So without comparing to Microsoft, but I do think it is a fair case, you can see it's about $53 a share, so a bit overvalued, sorry. But with Microsoft, $67 a share. So Ben Graham doesn't like it. Dividend discount model kind of likes it. Comparable company model says it's a buy. And finally, the discounted free cash flow model says it's a buy. But as I said before, people like this. 2.85% dividend, $1.55. A safe dividend, and buy before the 2nd of January if you want those shares to be, do you want to be paid? So the next or final company I'm going to look at today is a healthcare sort of company, Johnson & Johnson. Currently trading at $157.18 a share. So we'll go back to my automated stock valuation spreadsheet, and we'll put in the ticker J&J. And wait for all the company financial data to load once again. Price $157 a share. Market cap of $378 billion. And a PE ratio of 26, so slightly below the market average, which, as I keep saying, is around about 30. Earnings per share, $6.05. A beta of 0.52, meaning it's a lot less volatile than the market. And analysts saying it is a buy, $175 a share. Now, as we say, very nice dividend yield, 3.13%, meaning if you own the share for a year, you would get paid $4.92. Payout ratio is a little high. They pay slightly less than $12 billion in dividend, 80% in terms of net income, and 81% in terms of free cash flow. So it is a little high. If we look at other numbers here, you can see really, well, we'll break these down a bit. Ex-dividend date, 26th of November. So buy then before then if you want to get paid your quarterly dividend amount. Revenues, not all-time highs, almost all-time highs. I did not see this number, but $87.54 billion. And once again, consistently trending upwards, which is what we want to see. Net income, apart from the blip in 2023, they have kind of been trending, well, been very consistent actually. Anywhere from 15 to 13 billion, apart from a couple of drop off here in the last since 2010. So really, we would like to see this growing a lot more. But yeah, 14.68, down from the all-time highs of 35 billion. Free cash flow, similar story again. Down in the last few years, 14.47 billion, down from 18.25, down from 17, down from 19. But let's see what's happening here. Operating cash flow, that's what we like to see. It is still trending upwards. It is up, but CapEx has been all over the place. Yeah, so CapEx up, operating cash flow is up, but yeah, still, the operating cash flow is going up, which is what we want to see. Shares outstanding, they're buying back shares, consistently rewarding shareholders. And now we'll have a look at the discounted free cash flow model. So let me just reset these numbers here. Wow, okay. Discounted free cash flow loves the stock, $246 a share. Now, just out of interest, this is why you can't look at these things immediately. Stock has never been that price, $170 at its peak. So let's see if we can look at these numbers a little deeper and see what's happening. So revenue growth rate, we're estimating, well, very small growth, 88 billion. Let's see what analysts are saying. They are expecting 88 and 91 billion. So they are expecting it to still be growing and around about 3% per annum in terms of their growth estimates over the next 5 years. So we will, I've forgotten the numbers. I just said it was 80. There you go. I mean, we'll go a bit more conservative, 2.5%, $262 a share. Next, we look at the, that's why net income margins had a massive year of 44%. We're going to take the most recent year of 16.77%. That brings us down immediately to $181 stock. See, this is a lot more close to what we like to see. I'm pretty happy with this net income to free cash flow. I mean, obviously this is an average. They've had some high years, some massively low years, but we're kind of looking at, I'd say, yeah, probably maybe even more to 100% we'd go to here. But $185 a share, meaning discounted free cash flow does like the stock. Dividend discount model. So average growth 5.79 and a weighted average cost of capital. Yeah, so I don't think that's going to be fair. I mean, yeah, it's putting it somewhere in the region of a $200 stock based on the dividend discount model. The more I use this, the less I like it, but it's part of the tool. I think you have to throw out a lot of the answers, or maybe I'm doing it wrong. We'll see. Now we'll look at the Ben Graham formula for intrinsic value. I'm going to say he's not going to like this. They never seems to, and we had about 4% growth, was it, over the next 5 years? 3%, even less than that. So 4%, it was about 6.5 the last 5 years, $80 stock, whereas $60 stock. So Ben Graham doesn't like this, but comparable company model, let's have a look. So some tickers are ABBV, which of course is AbbVie, LLY, which is Eli and Lilly and Co, and PFE, which is, of course is Pfizer. So let's see what we, wow, prices all over the place here. That's crazy to see. As low as 116, as high as 350. Let me actually just quickly go Seeking Alpha J&J comparable companies. Merck, Bristol Myers Squibb. I mean, I can see the tickers that I did pick on here. So I just wanted to see if there was maybe some that were jumping out at me a bit closer. I think Pfizer is definitely a key one here, but enterprise value, one of the smaller ones, actually not really, same size as AbbVie, half the size of Lilly, and twice the size of Pfizer. Revenue, highest revenue though, 87%, smallest growth. EBITDA highest, net income highest, second highest profit margins, price to sales second lowest, price to book second lowest, PEG, all of these are under 1. Very interesting. You can see here price to earnings growth, it is the highest, but as per Peter Lynch's formula, is a buy. So quite interesting to see here. EV to revenue second lowest, EV to EBITDA basically tied with the lowest, PE definitely the lowest there, and forward PE second lowest as well. So that's why $116 a share on this one, but $300 for everything else. So it is a buy according to the comparable company model. Dividend discount model kind of likes it. Ben Graham hates it, and of course the discount free cash flow model says it's a buy. But once again, 3.13% dividend, which would get you $4.92 a share. So yeah, that's about it. Hope you enjoyed the video. I'm doing something a little bit different. Give me some feedback in the comments if you like this style of video. I mean, I still like to look at the individual stocks, but I think this was just a change of pace. 2024, new year, new president, new everything. So yeah, let me know. Give me some feedback in the comments if you're interested in these style of videos. I know they are quite popular, and I still enjoy doing them. I still like looking at these companies. So yeah, give me a like if you're interested, or dislike if you're not. Give me a comment, give me some feedback. Check out my Patreon as well. And yeah, I'll catch you guys next time.